Next, we'll take up item 6.8, our 10:30 a.m. item. I've been told it's solely Mr. Sullivan, our tax collector.
Correct.
Consideration of the June 30th, 2024 report of Lake County pooled investments. Good morning.
Good morning. Yes, it is just me today. I do not have Carlos with me, but hopefully I'll make this short and sweet. And I'll run through our main presentation first. And if you have any questions, I can take them as we go. And then I can show some of the historical data related to interest earnings and apportionments that we've done here. All right, so this is just some of the data we have about our portfolio in general. One of the things I wanted to highlight is that our pool is starting to grow a little bit in terms of age. Our duration's increasing. That's partially because we're anticipating that there's going to be a rate cut. The Fed has definitely indicated that one is coming. So right now we earn more in our shorter term funds, but that is expected to change over these coming years. So we want to start lengthening our core portfolio to anticipate that change. And that's going to, hopefully as our core portfolio, our earnings rate is going to increase as our short-term rate decreases. So that'll start to level each other out, but we should still see continued growth. What's one of our charts that would be helpful? This is our chart showing sort of over the last 3 years where we've come from. If you notice in August of 21, we dipped down. Our earnings were pretty low at that point. We weren't getting much of a return, partially because of the structure of our portfolio as well as the market environment. It's during that time period that we started with Chandler Asset Management, if you recall. So you'll see that there's sort of been an increasing drive upwards, and it's been fairly level. Later, you'll see a chart that shows some of the earnings on a quarterly basis. That's going to look a little more erratic because of the fact that payouts from different maturities come at different times. Different bond payments. A lot of times interest payments are only made twice a year on a bond, so it can be erratic depending on when it's purchased and when it pays out. So you're not going to see a completely steady stream of income coming through. This chart is showing that overall rate of return, so this is a bit more level. So this may give you a better picture of where we really stand and where we're going. We would expect this rate at this time, assuming the rate environment were to remain the same, or if we just see some small cuts from the Fed, I think you could expect to see the same sort of increase for the next 12 to 18 months. But honestly, after about a year from now, especially with this anticipated rate cut, it's going to start to level out. And especially because of how we're restructuring it and what you're seeing, at that point, I wouldn't anticipate that increasing rate of return anymore, unless, which I get to, we'd have to make a few changes to our portfolio. But even that, any increased returns at that point will be minor. So again, we're going to see this continuing rate going forward, probably for at least the next year. This is some other data about where we stand in our portfolio. This is the liquid funds, and we don't have to get too into this, but what I think is important to remember, just to highlight, we have our core portfolio, but then we also have a more liquid portfolio within that. This is much shorter term in duration. This is where you're seeing 0.2. You're seeing this high rate of return because of the inverted yield curve. We're keeping more money in this partially because of the uncertainty at the state level about funding. Other questions, we don't know exactly when we're going to expend funds at the county level. So due to these different factors, we're slowly increasing the liquidity of our portfolio right now, having more cash on hand, which does not hurt our return at all. Right now in the current environment, it's actually driving our return up to a certain extent, but that is not normal. So I just want to let everyone know that I would guess within the next few years, that's going to change, and that the money we're keeping liquid normally should not be able to earn a higher return than our core portfolio. This is sort of upside down, and it's partially because our portfolio is still so young. Our portfolio is not fully developed because we're a recent entry into the market. So I think that those are probably the core points I want to share about our core portfolio. I can move on to some of the other graphs, but is there anything anyone wants me to touch on while we're still looking at our end of year report?
See no questions. Please move on.
All right. I'll try to keep this speeding along. So this is the history of our earnings over the last few years. We've shared this chart recently for the last few years as we started this program. I'll just highlight again, this is back in 2021. So this is in alignment with that chart I showed earlier about the earnings ratio. You'll note that we're down in the $90,000 to $100,000 range as our portfolio started. We've continued to climb as we've developed it. As you go along, you're going to see that fairly steady increase, but like here, where you see that 1.2, it kind of levels off, or here where it goes from 3.6 to 3.5. That's, again, what I'm talking about. It's generally related to how the securities are held when they mature, and there's a bit of timing. But I'd also note on these quarters where you see that dip or leveling, those are often the quarters where our balances are starting to drop. It's a Q2, so I guess what I'd say is we don't have property tax revenues in yet. So we've been spending down the money that we got in December and April. So our fund balances tend to drop as we get closer to property tax season. Once the bills go out in November and December, we're seeing money coming back in. So especially as I pointed out earlier with that short-term yield, we're actually getting really attractive yields on that money right from the day we deposit it. So that's been driving some additional revenue. So again, right now it's sort of leveled off. I would think this quarter could potentially be the same or even lower, the one that we're in, because our fund balances are going to continue to decline a bit. But then we should see that uptick again as the year goes on once tax revenues come in. And then I can walk through some of the apportionment data. Before I do that, were there any questions on this part? Okay. So what I also posted, your board had previously requested data on interest apportionments and sort of a understanding of what each district and what each fund type has received. Within the county funds, it's a little more confusing, and you may even need to refer to admin for further explanation about what it all really means. But this is the breakdown by fund. So I think some of the questions we had earlier were regarding what various school districts had received or special districts getting that breakdown. And just for example, if you look at some of the schools, that may be sort of a cleaner picture of how increases have occurred. Lakeport Unified, for instance, you're going to see how they were down in the $18,000 or $7,000 range before our investment program started. As we ramped up, it went up to $76,000, and this is their primary account. Most of the school districts have several accounts. They went up to $76,000. Right now, there's $340,000 so far that's been distributed. And again, I want to highlight that final column is only reflecting Q1 through Q3. So there's still that $4.5 million that we brought in that has not been distributed yet. So on average, these figures should go up 30 to 35%, but it really depends on what each individual fund balance was, because we distribute based off the average daily balance. So that's may just give some kind of marker. So I really want to be sure that I qualify that this is a preliminary figure and most certainly does not include fourth quarter of this year. So if you go through, you can look at all the different funds. I'm happy to answer questions where applicable. However, for the inner workings of those funds, you'd have to follow up with whoever's managing them. I can only speak to the general fund balances. So unless there's any particular questions, that's the end of the presentation. I'm happy to look into bring anything back up that the board may wish.
Thank you very much for your presentation. Any questions or comments? Supervisor Green.
Just super quick on the last attachment, the historical interest portion that kind of breaks it down by fund. Do those figures kind of represent acting balances within those funds that are unallocated and are therefore available for investment?
So all of those funds are held, while you see the fund balances, if you were to go into the county finance system, you see the fund balance broken down in that manner. But the reality of it is, from the Treasury perspective, they're all held in our pool, which represents our operating account at Wells Fargo, our custodial account at US Bank, where all of those investments are held, as well as all of the other pools that we participate in, local government pools and the state pool, LAIF. So those funds from Treasury perspective represent these larger figures. That breakdown that you're seeing is really driven more by the fund balance monitored by the Auditor Controller's Office in conjunction with the CAO's office. I don't know if that answers your question.
Well, I don't know. I'm looking at line 3, Fund 64, Cannabis Fees and Taxation. I see the first 3 quarters of 2024 fund balance of about $362K, calendar year 2023, a little more than $250,000. So I'm trying to get my head around what the current fund balance might be of cannabis-related income, but it may be hard to do on that line item because it looks like fees are mixed in there.
And it's solely the interest apportionment. It's not a fund balance of that budget unit.
Yeah, this is just the interest, so you can't extrapolate that out. I can provide that information for you later, though. This is just the interest that would be going into Fund 064.
And I think it's really quite
one revenue account, sorry.
Sorry about that. I think it's a complicated situation to look at these numbers. I think it's a good place to get an idea of what's happening, but is 100% of that fund being invested, or is some of it kept liquid? That's not detailed in here, so you only know what apportionment was paid back into that fund based on the investment policy that we have. And I think that just gives us an idea of how it's supporting whether it's outside agencies or in agencies within internally, of what are we gaining from this new investment policy that we have. And I think these numbers speak for themselves, that this is outstanding, the difference that these agencies and internal departments are going to, what they can do with these extra resources that they're receiving. And I know that I used to get emails or phone calls from school districts, or not school districts, but Canocti Unified School Districts or Lake County Fire Protection District, complaining about what is going on with this investment. Either we're really behind in providing the apportionment, or why is this so small? I haven't gotten one saying that, wow, this is awesome, but I will take the lack of the phone calls, meaning that they are now happy with what is happening, because the difference is huge. I mean, just looking at Canocti Unified School District, again, it doesn't have the details of how much is truly being invested, and maybe they added some more, but they went from something like $22,000 to $1 million on their, on 2022, it was $22,000 and up to $1 million, and that's only 3/4 worth of interest apportionment. And so, to me, outstanding work. This is exactly what we needed to do. We are the responsible party for this investment policy. It interacts with a lot of different agencies, and I think we're doing the right job. So, thank you very much.
Thank you. And I would highlight that the way we do the calculations for the Treasury pool is that we bundle all the earnings into one calculation for the pool return. We deduct the expenses incurred by my office in managing the pool, and then we make the distribution after that. So everyone's seeing there is no case where a specific entity has its funds invested in one particular item. Everyone is part of the pool and pulls that one rate of return, for better or worse.
Thank you very much. And with nothing further from the board, let's open it up for public comment. Anyone wish to speak on this item? Please come on up.
Paul Duncan, and put my hat on as Assistant Chief for South Lake County Fire Protection District. So I'd just like to thank you for being a good steward of the taxpayer dollar, and especially the district dollar. Previously on our reserve account, we had very little return on that, just historically. So seeing the numbers in there and the return on that that comes back and we can actually use for operations within the district is huge. So I just want to say thank you and good job.
Thank you.
Thank you for your comment. I see no hands up in Zoom and no one else moving in the chamber, so I'll bring it back to the board. Just a presentation.
Yeah, I believe in the past your board has moved to accept the report. I don't know if that's really necessary, but that has been your custom.
Yes, it can be done either way, either by motion or no action and treated as a presentation.
I'll move that we accept the report.
Second.
We have a motion and a second. All in favor?
Aye.
Any oppose? Motion carries.
Great job.
Thank you, Patrick.
We didn't want to be any different with just you presenting.
Yeah.